Hey, welcome back. After another exceptional quarter and year, Palantir is up significantly since a few years ago. Last year was again very good, with a 29% increase in revenue and great margins in pretty much everything. The outlook was also great, with about a 30% increase in revenue and very solid margins, especially in adjusted cash flows. I'll tell you from the start that the company is really good, very healthy, exceptional margins, has pretty much a monopoly, but the stock is maybe a bit too optimistic, but more on that later in the video. The margin has been improving as the company became profitable recently, now standing at around 18%. Now, what's probably the main attraction is the company's growth and especially future potential. So far, they managed to do something in the mid to high 20s, which is indeed very good. However, as they are developing and reaching a bigger size, that's now expected to fall in the low 20s and will naturally continue to fall unless they do some acquisitions or something to ramp it up. Financially, we see an exceptional position, with the current assets covering the total liabilities like 5 times. However, we see that basically all they have is in marketable securities. Pretty much everything is in US treasuries, so quite similar to cash. But with falling rates, we might see them focus on other investments in the future. Now, very importantly, about half of the net income last year and more than half the year before came from interest on the treasuries. So that 18% margin is more like a 9-10% maybe, and that's quite an issue with the falling interest rates leading to lower treasury yields, so that won't be an option for the future capital. But does such a company really need a 4-5% bond when they can find much better? So far they haven't had some amazing return on investment because again, it's a growing company that became profitable like 2 years ago, so we don't really have data. If you look into it, they have to spend a ton of money on selling and marketing, general and administrative expenses, and not that much on R&D. The free cash flow is better and I think an overall better indicator because it doesn't include the stock-based compensation, which is a non-cash expense, they just issue them. Here we see much better numbers with like a 37% margin on the revenue, and without the interest it's still 30% while the company is developing, so very good. If they keep this up and ramp up the revenue, this can indeed be quite a huge company, but keep in mind that you have to pay like 200x what they make today, so a lot of growth is already accounted for in the price. Now, sure, it's a monopoly, especially Gotham, and of course they are developing and growing so well. You should be very worried if they didn't. It's almost impossible not to do well offering what they offer in this market. Don't underestimate how much the US government can spend on defense and security. And if you think about it, 2-3 billion in revenue is not much at all. If they develop in, say, France, Germany, Canada and so on, there is potential to easily multiply this revenue. Now, they say there isn't competition, which, if you talk about the quality of this deep data analytics and intelligence, is kind of true. The CIA, DoD, FBI, NSA and so on wouldn't choose just any company. The risk, however, would be having another or maybe even more small companies do this and the government wanting to diversify or even having a fully owned private company do it. I mean, Peter Thiel, a co-founder, owning like 28% of the voting power could be seen as a national security risk. It's politics after all. As a note, it's not an issue that it's a public company now. The share structure is made to avoid hostile takeovers, but it's an issue if they don't want to give so much power to a single company. At the same time, the real growth and potential probably comes from Foundry and Apollo, so commercial, not government. There, they face a lot of competition with a lot of money. Google, IBM, Amazon, Snowflake, Microsoft make even 10-20 times more than Palantir's revenue in profit per year. So if they prove that there is an opportunity to make good money here, someone will follow. Can they make like 30 billion in revenue at the same huge margin for this to be a fair value? In time, honestly, maybe, but until then, any issue or worries about the competition, the market and so on would make it crash. Again, it's a very tiny company today at not even 3 billion in revenue. For it to be worth almost 200 billion, you need a ton of growth, which is possible, but many things can go wrong. And and then for it to keep growing from this level, you need to beat the market's expectations or more love or hype from the market. We'll see more in the valuation segment. And this isn't about the company that's good and healthy, but the stock is very different. Now, the advantage they have from the stock point of view is that being valued so high, they can keep issuing and develop using the stock. You know, a 10% dilution over a few years is worth more than the company has ever made. Because, again, by itself, no matter how good it is, the company is small and the potential is limited on such a market cap. I mean, organically, when they make like $1 billion per year or even less, how much do you think this can grow reported to the nearly 200 billion market cap? At the same time, do they have something to invest in? Remember, they hold a lot of 4-5% treasuries, so why aren't they investing it? And not to say the company is bad, because it isn't. Huge moat, healthy, lots of potential, but is the stock reflecting the reality? Now let's see a valuation. In a bad scenario with higher competition, let's say the growth rate in the long term is somewhere around 15%. As a note, that's generally very good for any company, but given their particular environment, I think it's okay for a bad scenario. Assuming that the margin remains the same, in half a decade that's 2 billion per year. For a ratio of 20, which is again pretty high, that's a market cap of 40 billion, meaning a price of 17.55, so quite a significant drop. And again, for any other company, this would have been quite a good scenario, but I'm accounting for maybe even too much. In a second scenario, let's say they keep developing at 25% per year, which is around the current level and again, a lot. Assuming the same margin, that's about 3.05 billion in half a decade. For a ratio of 40 to show a lot of confidence from the market, that's a market cap of 122 billion and a price of 53.54 for a loss of around 30-40%. So even if they theoretically triple the revenue in half a decade again, that's probably below the market's expectations. Either that or it would value the company at a much higher ratio. In an even better scenario, let's say they manage to develop a lot in commercial and deliver a 35% compound annual growth rate, leading to around 4.48 billion in half a decade. For a ratio of 60, which is again insanely high, but so is the growth rate, that's a market cap of 268.8 billion. That's a price of around 117.95, meaning a profit of around 40-50%. It's not terrible, but it would likely underperform the general market even in such a scenario. And you barely get a profit if they do 50% better than they did so far and basically 4-5x the revenue in half a decade. How realistic is that? It's simply not worth the high risk in my opinion. And look, ultimately it doesn't matter what the company does. It's all about the money they can make, how much they can grow or how good of a story they can sell. The latter, however, has to be proven because if they were to keep under-delivering the first two, the market's confidence will fade and you'll see significant crashes. The role of a company, no matter what it does, is to make money, and that's why people invest, to have them make money for them. So sure, if you bought back in 2022 or 23, that was a much better risk and reward potential and you are already up like 10-15x. It's been an amazing investment. Now, however, it's a very different balance. Overall, again, a very healthy company with potential, but at this price you basically need them to do much better than before to see a profit in the long term. In the short term, sure, any good report or news can make it jump even more. But at the end of the day, it's all about the risk and reward you prefer. It's a good company, but the stock is too speculative in my opinion. 2 years ago, sure, would have most likely been a buy even for me. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.